Okay, so the last class we went through and we calculated variance, right? And then we stopped there, and we haven't covered this one yet. This slide. So this slide is kind of another all page kind of overview of different types of financial assets. Some of the more common ones, the bigger classes. And so it lists common stocks, which are basically, all stocks in the stock market. Then it lists just small company stocks, long-term corporate bonds, long-term government bonds, and intermediate term government bonds, and treasury bills, and then also inflation. Now, you may recall treasury bills go from 0 to a year. And then intermediate bonds, I don't know if we've talked about that before. Intermediate bonds usually go from a year up to about 10 years. And then long-term bonds typically are, over 10 years. So there is that intermediate period. I don't know if we talked about that before, but anything over a year and under 10 years are typically called intermediate term government bonds. And that's more lingo. It's not necessarily, a scientific definition, because like on the balance sheet, anything over a year is typically going to be long term, but that's just another description. So the thing to see here is that for all these different asset classes, these financial securities we listed here, you'll see first off the average annual returns, okay? And it kind of goes from mostly high to low, but you'll see small stocks are a little bit different than other types of stocks. And then it lists the risk premium. And if you recall, the risk premium from last class is basically that extra stock return above the risk-free rate. So the risk-free rate is the treasury bill, right? And so the amount above treasury bills is your risk premium. And so there may be some rounding issues, but if you take this US Treasury bill average return 3.9 and add it to all these risk premiums, right, you should get the total average return. So there may be some, it's pretty close. There's a little rounding someplace here in intermediate bonds. And then this column here, standard deviation, measures the historical annual standard deviation returns. Because you remember last class we looked at something called a histogram, right? And it was kind of your classic bell curve thing, right? And the histogram basically shows you the frequency range of historical stock returns in kind of different buckets, right? So how many times did the stock market return minus 10 to 15%? How many times did it return minus 5 to minus 10%? How many times did it return 0 to minus 5? So it kind of counts that up, that frequency, and puts it in these buckets every year and makes this chart. And usually when you chart something like that, it looks kind of like a normal distribution or bell curve, if you recall from your statistics class. And that's what this final column over here on the slide is. It shows the historical frequency of different returns for each of those financial assets. And so one thing you'd expect to see, like we talked about last class, is that riskier assets with higher standard deviations will have a wider distribution. Okay, because that in finance, that is how we define risk. That's like the first level of risk definition. It's standard deviation of historical returns. And check out the common stocks here on the chart. You'll see it's a fairly wide distribution. It does not look like a normal distribution, if you ask me, right? It's a little choppy, and it doesn't have like a real high point and then down either end. It's kind of flat in a way, right? And then take a look at small company stocks. Small company stocks are known to be riskier than the average stock. So what that means is, look, returns are a little bit higher to compensate investors for that extra risk. The standard deviation is higher, right? That's how we measure risk. And you look at this chart, you'll see a much wider distribution of returns. Some really, really high return years, but then also some really, really low return years. And then as we go from corporate bonds, long-term bonds, down to intermediate and US Treasury bills, we see the standard deviation typically gets lower, right? And then we also see that distribution gets narrower. And that distribution, you know, that the width of that curve, if you will, the bell curve, is our standard deviation, basically. The other thing I want to point out to you is inflation at the very bottom. The average is about 3.2% per year. And so you can kind of see, right? If you put all your money, let's say your retirement savings or something, in a money market account or cash account, you know, you're going to probably make about, on average, historically, you know, 3% And you see with inflation, that takes away all your returns, basically. So while putting money in cash is a good short-term solution to make sure you have the money in a case of emergency, it's for long-term planning, it's not good because you won't keep up at that rate. Inflation will eat into your returns. So that's kind of an overview of risk and return. So here are a couple generalities on risk and return for investors. All things being equal, investors' highest preference is for something with really high returns and really low risk, right? But you know, if you hear someone telling you they have an opportunity to earn really high returns with really low risk, you should be very skeptical, because typically, if you're offering high returns, that means there's a reason for those high returns. Potential returns is because the risk is so high. So as you increase risk, investors demand higher returns. But if you have something that's not very risky, usually if it really isn't risky, then investors will accept lower returns on it. Okay, so if something is not risky, then investors will take lower returns. And so high risk, high returns, low risk, low returns. And so that's kind of a basic premise that kind of underlines this whole concept of risk and returns. So let's talk about another concept called diversification. So diversification is basically where you spread out your portfolio, your investment portfolio, across different assets. Some of you have probably heard the term, don't put all your eggs in one basket, right? Because if you drop the basket, you know, most of your eggs are going to break, right? So if you put your eggs in multiple baskets and only one basket drops, you don't lose all your eggs. And so that's kind of the same logic behind a portfolio. As long as you don't put your whole portfolio in one stock, you'll be okay if that one stock, something bad happens, because you're spread out among multiple stocks. And so as part of this, we want to introduce a way to calculate returns for a portfolio of different stocks. So we call this the portfolio return equation. It's basically a weighted average of returns of each individual stock. So in this equation, W1 stands for the fraction or the percent of your portfolio in dollars invested in like asset one or stock one. R1 right here is the return of asset or stock one. W2 is the percent of your portfolio invested in stock two. and R2 is the return on stock 2. So your overall portfolio return is basically a weighted average of all the individual returns of your stocks that you're invested in. So like, for example, if we only have 2 stocks and 60% of your money is invested in stock 1, then automatically that means that 40%, the other 40% is invested in stock 2. So W1 and W2, the fractions kind of have to add up to 100%, right? Here's a simple example. Suppose you invest 60% of your portfolio in ExxonMobil and 40% in Coca-Cola. So those are the W's. W1 is 0.6, 60%, and W2 is 0.4 or 40%. The expected return on your ExxonMobil stock is 10%, so R1 is 10%, and the expected return on Coca-Cola is 15%. That's R2. Calculate the expected return on the portfolio. So we just use that previous equation and we plug it in. So I plugged in 0.6 for W1. This 10, that's kind of really 10%. Sorry about that. And then the 0.4 is the W2, or the fraction of the portfolio invested in Coca-Cola. And then we multiply it by R2, the return of Coca-Cola. 15, that should be 15%. And so that gives us a total portfolio return of 12%. Not too bad. Weighted average is how we calculate portfolio returns. This slide shows you what happens when you take 2 stocks and form a portfolio with them. And then it shows you how the value of that portfolio changes over time with respect to the 2 individual stocks in your portfolio. So the top black line in this slide is think of that as stock 1, and that's called Network Mining Company. The green line on the bottom, that is stock 2, and think of that as Ford. And then the red line is basically a 50% portfolio composed of those 2 stocks. Now notice a couple things. The return should basically be about halfway between those 2 lines, right? And maybe this one looks a little funny, but for the most part, it's about 50-50 the way between, because right, the return of the portfolio is a weighted average, so they're 50-50, so you would expect those returns to be right in the middle. But the other thing I want you to just notice how the red line by itself, the portfolio, it doesn't move up and down as much as the individual black and green lines. Not moving up and down as much means it has lower risk. It has lower standard deviation. So that is how we see the positive benefits of a diversification when we build a portfolio, because portfolios will have lower risk than the individual stocks in those portfolios. That's the benefit of diversification. It's reducing that risk. All right, now I want to introduce a new concept. And this concept basically breaks up risk into 2 parts. The first part is market risk. And market risk basically symbolizes the risk from things that are across the entire economy. So when something changes, something happens that we don't expect, it happens to all the companies across the economy. That is market risk. So something like, I don't know, the pandemic, that affected all companies across the stock market, right? Now it affected them differently, but they were all affected. It hit all companies, but in different ways for each company. If the government drops interest rates, that affects the entire economy. If well, you get the idea. And the second part of this risk is called unique risk. And unique risk is something that happens that affects just one company, one stock, right? And so it's what we also know as diversifiable risk. And the reason we call it unique risk, diversifiable risk, is because if we own more and more stocks, unique risk won't hurt us as much, right? Because let's say we own 100 different stocks, and let's say one of those stocks is I don't know, let's say one of those stocks is Tesla. Now just imagine if the CEO of Tesla, puts up some tweet or something like that, and the stock price drops. That's something that's only going to affect Tesla, right? It shouldn't affect the entire economy and all the other companies in the stock market. So that's unique risk. And that is something that if we own a broad, diversified portfolio, it doesn't really risk us. It doesn't hurt us that much because each individual stock is just a little part, right? And those unique risks from having different stocks, they can also balance each other out. So if you have one stock with a unique risk, something happened that hurt the stock, you might also have another stock in your portfolio where something unique happened to that one stock and it helped it. So a diversified portfolio, some of this unique stuff, these unique risk kind of balances itself out. What this chart shows in the vertical axis is standard deviation. So think of this vertical axis as portfolio risk, right? So this is the total standard deviation representing risk for our portfolio. The horizontal axis is the number of stocks or securities in our portfolio. It goes to 5, 10, 15. And then I drew a line here. And this line represents what happens to portfolio standard deviation or risk when we keep adding more and more and more and more stocks to the portfolio. So think of it, what happens to portfolio risk when we diversify more and more and more. And the interesting thing here is, it drops but then it flattens out. And so depending on the stocks you put together in the portfolio, usually it starts to flatten out after about 10 to 20 stocks. And I just drew a sample here, and it kind of flattens out after about, but somewhere between 10 and 15 stocks, it flattens out. And so what we see are two components of risk here. If the blue line is portfolio risk, when it's dropping, that blue line, because we're adding more and more stocks, what that is showing is that how we're reducing unique risk. Okay? So everything above where the blue line kind of flatlines is called unique risk. And that's the risk that we can diversify away. But then there's this other part down at the bottom here, right? And the risk never goes below that. That's below where the blue line flatlines. That part we call market risk, because market things that happen to all the companies in the stock market doesn't go away just because you own all, more and more and more stocks. You still have market risk. So diversification. And the story of this slide is diversification helps you get rid of unique risk but it does not get rid of market risk. All right, so that is chapter 11. Oh, I see. Sorry, I saw Isabel said recession also affects the market. Definitely. Yeah, if we go into recession, that is market risk, and that'll affect all the companies. But here's the interesting thing, and we'll get into this on chapter 12. Even though we can't diversify our portfolio away from market risk, you can pick some companies that are more sensitive to the market risk, like a recession, and other companies that are not sensitive to the recession. Can you guys think of a company that will do okay in a recession? Yeah, we definitely saw this with the whole pandemic thing, huh? Amazon. Yeah, Walmart for sure. Yeah. Yeah, Walmart was always a good example of in my investments class, big grocery stores. Yeah, like Safeway, right? The thing, all these things, what you're kind of talking about are things that are um, staples. I don't mean staples, the store, but consumer staples are things that people always buy because they keep going through them and they keep needing them no matter what happens in a recession, right? But other things like Costco too, right? You got to buy a Costco sized container of paper towels, right? But paper towels, paper products, basic food stuff, people still have to keep buying that, even though the economy might go into recession. And so there are certain stocks that investors, if they get a feeling that the economy is going to go into recession, you will see these certain stocks rise in value or at least maintain their value. And those are like big grocery stores, like Costco, like Walmart. But then there are also companies that will do really bad in a recession. Can anyone name some stocks that'll do bad in a recession? Think about, like, what would you stop buying if we went into a recession? Yeah, I'm probably not going to buy that airplane. Yeah,
Yeah,
Boeing,
like the
right?
airplane companies, a lot of them, like
Yeah, I know what you meant.
all
I
their
was just,
stock dropped.
yeah, the airlines, Boeing, and stuff like that. Kind of discretionary spending, we call it, right? So things that you can put off and wait to see what happens with the economy, things you don't have to spend. Like sometimes some restaurants will get hurt, but not all restaurants. Some restaurants may actually do well, like cheap food restaurants. Sometimes, they do well in a recession, but more expensive restaurants don't do well. Hotels, travel, leisure, that can suffer as well, right? Um, all those, casino stocks can do pretty badly in a recession. Come back. All right, so I'm going to go ahead and move to chapter 12 now.